everyone. Welcome to the economics lecture series. This side Abhigyan welcome you in the Abhigyan Academy. So we were discussing about monetary policy. We have discussed in our earlier lectures what is monetary policy committee, and how this monetary policy works. Then we have also seen the different monetary policy tools. So today we will see and discuss on the certain topics of monetary policy where you see that RBI uses very often and it appears very much in the newspapers. Today we will be discussing about the monetary policy stances. Okay, when we say stances, stance means position. Stance. This word stance, it means position. Means position in what sense? Position means if there is a particular situation and you have to act accordingly. You have to behave, you have to decide certain things. Then what is your position towards that situation? That is known as the stance. Now there can be very much very different situations in an economy. Like there can be slow growth, there can be negative growth, there can be high inflation, etc. So based on that economic situations, the RBI should take certain stances. That is known as the monetary policy stances. Like the first stance is known as the accommodative stance. So here you have to find out the objective behind it. See, this accommodative stance is taken in what kind of situation? Okay. And so what is the objective? Objective here is to boost economic growth. That means the situation is that there is economic growth, but the RBI thinks that there up to a certain extent the economic growth can also be pushed. Okay. Say suppose RBI targets the economic growth as 7%, but the growth rate is decent. Say the growth rate is, for example, say 6.2, 6.2%. So it is a quite good growth rate, decent growth rate. RBI thinks कि 7% तक ये growth rate जा सकता है. So the objective becomes to boost the economic growth. And RBI is also sure that if the growth rate reaches 7%, the inflation will be in and around 4%. So RBI, that at that point of time, RBI will not be concerned about the inflation because RBI is pretty sure that if the if the growth rate becomes 7% or near to 7%, the inflation will be very close to 4% only. It will not cross the mark. All right. So the RBI focus on boosting the economic growth. To boost the economic growth, what would be the purpose? The purpose will be that the RBI will lower the interest rates. What happens if interest rate is lowered, then the money supply becomes more into the economy. Commercial banks can give low interest rate loan to the economy, to the market. So because of the low interest rate, the cost of borrowing becomes low. And people can borrow, the market can borrow money very low interest rate. So people will borrow more and more money and it will be invested into the economic growth process. All right. So that stance is known as accommodative stance. All right. So here it is used when growth needs support and inflation isn't an immediate concern. Okay. The next is neutral stance. Neutral. Neutral here means that RBI is very much neutral with the two aspects of its job. What was the job of RBI or the Monetary Policy Committee? RBI's Monetary Policy Committee, two aspects. One is to ensure economic growth and to ensure price stability. To ensure economic growth and to ensure price stability. All right. Now, in accommodative stance, The stance was RBI was concerned with the economic growth and it was not a concern. But in neutral stance, RBI will now focus on both. That it will also ensure economic growth by also looking the inflation does not crosses the mark. Alright. So it balances growth and inflation concerns. Ki the growth rate maybe RBI is thinking ki if 7%, the growth rate is now 6.2%. Say if it becomes 7%, then there is a threat of inflation that inflation might get out of the range. So RBI thinks ki we will balance growth ki chalo 6.2%. We can make it 6.4% or 6.5%, but we will not get to 7%. So it is balancing the economic growth without crossing the inflation benchmark. So balances growth and inflation. Interest rate. Now this interest rate can move in either direction. Ki RBI sees ki if we go for targeting a greater growth rate, inflation will rise. Then the interest rates may also rise to control the inflation. So interest rates could move in either direction depending on the economic data. Ki what is the economic data? What is the inflation rate? Inflation rate. So depending on the inflation rate, RBI will take a measure. So that is neutral. The third one is the hawkish stance. In this hawkish stance, objective is to prioritize control inflation. That means you get the situation here that the inflation rate, current inflation rate in India is very high. That's why RBI has decided to control the inflation. Otherwise, why RBI will decide it? So, say for example, it is 4% plus minus 2%, right? That means from 2% to from 2% to 6%. From 2% to 6%. Say maybe the inflation is very close to 6%, say 5.7% is the inflation rate. It may get very soon touch the 6% benchmark. So RBI is concerned with the inflation rate. So it will now prioritize controlling inflation. So to control inflation, what has to be done? The money supply has to be decreased. To decrease the money supply, interest rates must be increased. If the interest rates are increased for the market, the cost of borrowing will also increase. So people will be discouraged enough to take loan from the banks. Hence, money supply will decrease. All right. So that is a hawkish stance. Now, next stance is calibrated tightening. Now, in this calibrated tightening, it indicates a bias towards increasing interest rates. Here also in calibrated tightening also the interest rates will also be increased. Here also the inflation has to be controlled. But the difference between hawkish and calibrated tightening is in hawkish the interest rates can be increased abruptly. In hawkish the interest rates can be increased abruptly, sudden increase. But in calibrated tightening the increase will be gradual, not abruptly, in a gradual or measured way. Rate cuts are unlikely in this case. Means the interest rates will not decrease there, it will increase, but in a gradual manner, step by step manner. So that is calibrated tightening. Now, next we will see about the two differences of these two terms. One is expansionary monetary policy, another one is contractionary monetary policy. So, in what is expansionary? Here, expansionary means the economy must expand. Contractionary means the economy is very much inflated, it must contract now. So, in expansionary phase, the RBI it wants to boost the economic growth. And in contractionary monetary policy, the RBI wants to stop or lower the economic growth. If there is high economic growth, inflation has to be controlled, has to be decreased. and if the economic growth has to be expanded, the interest rates will be lowered. So you see, the goal of expansionary monetary policy aims to stimulate the economic growth and increase aggregate demand by lowering interest rates. In contractionary, aims to slow down the economy and control inflation, all right, by raising the interest rates. So if in expansionary, if interest rates are lowered, it will increase the money supply, and in contractionary, when interest rates are raised, it will reduce the money supply. Now in expansionary, when money supply is increased, it will encourage borrowing and investment, and when in contractionary, if money supply is decreased, then it will discourage borrowing and spending. All right. So interest rates will be what? In expansionary, interest rates will be lowered. In contractionary, interest rates will be raised. Now, what will be the impact of inflation on expansionary? In expansionary, the impact of inflation can be, it will go high because the inflation maybe is low, but it will be in the safe zone. Expansionary monetary policy can potentially lead to higher inflation due to increased money supply. But in contractionary money policy, the interest rates will reduce. Now, what is the timing when expansionary monetary policy will be there? Expansionary monetary policy is generally implemented during the periods of economic slowdown. Okay, when the economy is doing, it is under a slowdown phase or recession to stimulate growth. Now, in our lecture series, we will bring the different phases of economy, the different phases of the economic cycle. Like we will know about expansion, boom period, recession, slowdown, depression, recovery, etc. And the last point here, in contractionary monetary policy, the timing is typically employed during periods of high inflation or economic overheating. We will also look what is economic overheating. Okay. So now in this video, in this lecture, we came to know about the different stances of the economy. We came to know about the accommodative stance, neutral stance, hawkish stance, and calculated tightening. Next, we have seen the difference between expansionary monetary policy and contractionary monetary policy. I hope this is clear to all of you. If you have any question to ask us, you can call us for admissions also, for proper guidance also. So whatever help you need from Abhigyan Academy, you can just dial our number. So thank you so much. We will meet in another lecture series.